Thanks, Chris. Let's get analysis now and to Scott Phillips from Motley. Scott, good evening to you. Firstly, how do you interpret the big sell-off in the local buy now, pay later companies?
Yeah, Tomo, good evening. Chris did a wonderful job of summarising some of the big falls today. Not only Apple, by the way, but PayPal itself also launching a program that effectively means lower merchant fees for the retailers, and they're promising no late fees for customers. Now, that in theory should be the better product. It should be something that's superior for everyone concerned. But of course, Afterpay has stolen a very, very large march on the would-be competitors, and it doesn't always follow that just because the product is theoretically better, the customers go with it. That's going to be the new battleground. It probably is not unreasonable the shares fell today because there are two big new heavyweights in town.
Okay, so what's your advice to investors in Afterpay and Zip?
That's a good question. So, look, I am not a super fan at the current prices of these companies. I think we've talked about before, Afterpay's market capitalisation, its value is about 1/5 of that of American Express. Now, if you think about the Amex, this global behemoth with 130, 140 countries, whatever it's operating in, and you think, hang on, Afterpay's worth a fraction, but a big fraction of that, there's a lot built into those share prices. I think it probably is prudent to take half a step back. Remember that even though you're in the lead, nothing is guaranteed. By the same token, as I said, often it is those big early winners that do go on to win the whole game. So I wouldn't be selling in a panic just yet.
All right. The big winners today were utility companies, the best day in more than a year for the sector, with Spark Infrastructure, the market leader.
Yeah, that's right. And Chris mentioned infrastructure stocks as well. And again, importantly, because there's a couple of things going on right now. The first is interest rates. We know that. But there is also increasing talk. And Tom, we've talked already a couple of times this week about the mergers and acquisitions activity that's going on right across the ASX. Spark Infrastructure, the latest company to be fingered as a potential takeover target. And that was good news right across the sector for share prices.
All right. Now, Scott, this is an interesting one. An interesting move from the Reserve Bank of New Zealand ending its monetary stimulus, putting the possibility of rising interest rates back on the front page.
Yeah, that's exactly right. So if you think about what's been happening right now, it's hard to remember sometimes that the current rates we've got are emergency levels that are unprecedented interest rates. Now, if you think that through, an emergency interest rate, an unprecedented interest rate should only be in place while the economy desperately needs it. Now, on one hand, we've got obviously unemployment that's higher than we'd like, and economic growth is in trouble, and of course the lockdowns continue. So there is some grounds for the RBA to continue with its foot firmly to the floor. On the flip side, some of the inflation it's looking for is already coming through, and if it moves too late, it runs the risk of letting the economy get away from it and inflation as well. So there is some balancing act required by the central banks. The RBNZ making a very prudent move, I think, in saying we don't need to do all of this all the time. We need to find a time to start winding it back, and that makes some sense. Of course, it's going to be a very, very hot topic when it comes to Australia, and the RBA has been very clear that it's waiting for real results, real data to show that inflation's back between that 2 to 3% interest rate band, but the RBNZ might just be belling the cat that it's closer than we think.
Okay, now we get another big sign on how our economy is tracking tomorrow with unemployment figures out. What are you expecting?
This is a tough one. So the rate, of course, was 5.1% last month. The market is expecting a slight reduction of 5%. I think that's probably likely. Of course, a strange set of numbers right now because these are backward-looking numbers before the increased lockdown in Sydney and much of New South Wales actually took place. And so to some degree, while this information is important, what we don't yet know is what the next set of numbers will be. That's probably more valuable. So hopefully we see a moderate fall, if only because we may yet see a rise as the lockdown continues in Sydney.
Yeah, looking back, we're not quite sure what's ahead yet. Scott, just finally, how's Wall Street looking?
Speaking of looking ahead, at the moment, the futures are up just a bit, 0.1%. It's been a bit soft this week. The market really struggling to try and find itself a position to take. That has been okay for our market as it was today, so hopefully the same is true. But at the moment, just a moderate increase expected on the US markets.
Scott Phillips, thank you.